Live here with Mark Munson, CFO of CapSource. How you doing, my man?
Doing great, you Bill. How are you?
Pretty good, man. Thank you for joining us here on the Full Monty Realcast, and it's a pleasure to have you. I want to tell everybody about what you do, but I think you'll tell everybody best. Uh, Mark, take it away, man. Let us know what you do.
Yeah, so like you said, I'm the CFO of CapSource. My name is Mark Munson. CapSource is a hard money lender and loan brokerage based out of Florida. We lend across about 40 states to investors on everything from fix and flip financing to rental properties, short-term rentals, ground-up construction, and some multifamily storage facility stuff as well. So we're kind of a bespoke brokerage at times to kind of higher level operators, to new investors. We're kind of separate from other lenders in the markets or other brokers in the market in the sense that we are extremely consultative with our clients. So it's great to secure the best financing, cheapest, fastest, easiest, but at the same time, we want to make sure we kind of explain real estate investing in a more, macro level of what they're doing, understanding their business, what their, journey looks like and what they're looking to do to get to that financial freedom, and kind of helping them learn things like how to comp and acquire off-market properties, and how they need to structure their business from a perspective of proper underwriting as you're looking at deals, whether they're BRRRR investing or flipping. So kind of a hold your hand lender in that regard, until people kind of understand the financial landscape as well as everything else that goes into real estate investing.
Good deal. So you're not focused on the avatar or the customer that's looking to purchase their first primary residence or anything like that. You're working with strictly investors in the marketplace looking to make returns on their investment.
Yeah, we're not doing any primary residence or secondary homes. Everything we're doing is non-owner occupied based, which is the bulk of all hard money, financing. So, yes, strictly investment related. None, if you're living in a second home, that's not something we help with. We don't do conventional or traditional financing at all.
Okay. All right. Good deal. Yeah. So there is definitely a big divide on what people understand about financing. Most people's like financing's financing. We got to go to our bank and lender and things like that. But when you're dealing with like, why would somebody want to deal with like a company like CapSource hard money as opposed to going through their traditional channels of a conventional mortgage in this case?
Yeah, I mean, when people, I encourage everybody to go your traditional, conventional route if you qualify. But in reality, most people with debt to income reasons, or maybe they're self-employed and not able to show that income, makes it more difficult for them to qualify for conventional, mortgages. So they typically come to us for a myriad of reasons. Number one is the properties might be distressed, and you can't get government-backed financing on the property in its current condition. So you have to take out that fix and flip, that rehab loan, regardless if you're selling or going to refinance it, hold it. It could be, like I mentioned, debt to income purposes. Our loans don't report to credit bureaus, so they're not something that's going to affect your debt to income, and it's not a factor that we're looking at. It's more asset-based lending. We're lending on the collateral itself and what that value is, and we're mitigating the risk of that lending by looking at maybe the liquidity you have or your experience in this space. So it is a bit easier from that regard of, we're not looking at tax returns, pay stubs, 12 months of, bank statements necessarily. So it's just ease of underwriting, ease of qualifications, and practically anybody out there can qualify for hard money financing if they have a heartbeat of a credit score and or a good deal.
Yeah, so I guess that's really what comes in key is, right, is where what the asset is worth, what the asset could generate. Being able to base your funding or your financing just off of that is going to keep investors out of a lot of trouble.
Correct. I mean, and that's something that is part of what we coach here, is really understanding what an after repaired value is, really how to comp different properties, because I think people kind of get this mindset of, I want to start investing, and they just rush out to find a deal, and they don't necessarily have clarity on what really is a deal and how to properly assess it. unless they're working with like a realtor like yourself that knows what they're doing or knows investment or has investments themselves. Quite often they'll trust maybe what a wholesaler is telling them, which is not always the best, course of action. So helping them understand how an appraiser is going to assess their property, because when they go to sell that property, more than likely they're going to sell it to a traditional home buyer, and you want to know how that appraisal is going to take place. What is a common adjustment for a larger lot or a 2-car enclosed garage versus a carport? So helping people understand that to where their risk is lowered as well. They're making the right max allowable offers on these properties, and they're not going to run into a situation where, hey, I didn't know I needed to replace the roof, or I opened up the walls and something else came up, and making sure they have that buffer there and that contingency of rehab money there should something arise. And we've really run our numbers well to kind of mitigate against the unknown and against any market shifts.
Yeah, that's one thing that I'm warning all my clients about is market shift, right? The sentiment of the market right now is very like cautious, right? So you have to account for additional marketing time. You have to account for, the possibility of a price reduction, if your rehab takes too long, right? Because we don't know right now. We're looking at, 90-day windows, right? And sentiment, right? Real estate doesn't work as quickly as stocks do. You can't just watch it on a ticker, but you can see inventory rising and things like that. So if your rehab is going to take 6 months to complete, right, because it's a real, shit show of a house, then you know that, you might want to price a little buffer in there because, I don't know what the market's going to look like in 6 months in this neighborhood, right? It might be better. It might just be stale. It might, people might have pulled back 2 or 3%, right? So that's a good point.
And to add to that, it's one of the things we teach people is you have to build your team, right? And your team in real estate investing includes an investor-friendly agent like yourself, somebody that can calculate the days on market, understands the differences between this neighborhood and that neighborhood, understands seasonality of maybe your market. So you need somebody there that's investor friendly in that regard. No differently, you need somebody that's the financing arm. And I tell everybody have 10 different lenders. Every lender does something different. Have a good broker, have as many access to as much capital as you can. But part of that capital side of your team has to be consultative, somebody that knows where interest rates are going. Because that's the number one question I get asked all the time is, hey, I'm going to do the BRRRR strategy, which is the buy, rehab, rent, refi, repeat. And when you're BRRRing, they're not calculating where rates are on the long-term loan. And they just think, hey, I'm going to cash flow. Well, what happens if the Fed increases that rate again? Now we're even higher, which is taking your cash flow less and less and less. So understanding of just having people around you that really understand investing, it's no different than investor-friendly title companies or attorneys, investor-friendly insurance agents. You're running a business, in all parts of that business, from your realtor, your financier, to the insurance, that all helps you efficiently to get to closing, to understand that you're properly underwriting these things. Because to your point, the worst thing you could do is buy something where its days on market is now being extended, and you could have looked at those market conditions, got ahead of that, and adjusted your price of your offer to buffer against, hey, I'm going to have to hold this for another 30 days than maybe this other zip code that I do a lot of business in that's moving faster.
Right. Absolutely. And I like that you touched on the offer part, because it's not that it's not going to be a buy, right? Like the deal may very well still be there. You just have to know that you have to adjust for that the additional holding time. And, at the end of the day, that's all we have to do, is because we make money when you buy the property. Everybody thinks, oh, you make money when you sell it. No, you make money when you buy it. You buy it smartly. You know what you're getting into. And then, this way you already know your numbers going in. They could be better, but they should never be worse.
100%. I tell everybody the same thing. You don't make it when you sell the property or collect your rent check. You're making it when you're purchasing it. Right. And every property can be a deal at the right number. Right. And I think people will see listing amounts and they get deterred from making an offer. And it's just a numbers game at the end of the day. If I make 1,000 offers and they're all balled against what the individual is asking for, If one accepts it, that's all I need. So you're again running a business and you have to understand what is your max allowable offer. And typically starting with the end and working your way backwards is best. And what I mean by that is figure out what your after repaired value is, which you can do by pulling rehabbed comps in the area. Then understanding, okay, my total project cost, my purchase price plus my renovation budget cannot exceed this. So now I can work back, okay, this property needs this level of rehab because I did an inspection or walked it or whatnot. So then it'll inform you of where your offer price needs to be, or at least where the max allowable offer price needs to be to make sure the rest of the numbers make sense. And that's true of if you're using hard money as well, because everybody wants best leverage. They want 10% down on hard money, which you can get, but we never exceed that 75% of the ARV. So if we haven't worked our numbers fully one way or another, we're going to have issues when we get through underwriting and you're having to put another 5% down.
Right. See, I'm from the old school where all hard money was 35% down, right?
Yeah.
So I wanted to touch on that because that's something that some people may not know about, but you could get into hard money with 10% of ARV, and you have programs that help new unfunded investors to fund their renovation costs. You want to tell people about that a little bit, or
Yeah.
how that works?
So what you were talking, like my business partner has been in this business quite a while. And what you're mentioning is back in the day, it was true asset-based lending. Sometimes we didn't look at credit scores and, you'd had a set amount that 35 or 30% down. We've seen institutional capital from Wall Street move into this space, which has brought more guidelines and more conventional underwriting into here. And it's allowed different loan programs that are helpful, like DSCR loans. But it does, change things to what it really was true private money. And to your point of what we do is typically, depending on somebody's credit or experience, we offer 85 to 90% of the purchase price, 100% of the rehab costs, as long as our collective loan amount isn't exceeding 75% of the ARV. And in general, you don't want to be at 75 anyways on a fix and flip. It's probably not a good fix and flip, or it's tight numbers if you're already at that 75. Right. So most people just need to start with either 10 or 15% of the purchase price, which in some markets is very doable. And again, it's just finding that right deal that makes sense. The also good thing is you do not pay interest on that rehab money unless you use it. So if you got other credit cards at 0% APR, or maybe you have a Home Depot Pro card or something along those lines, utilizing those things as you're getting through that rehab is going to keep more capital in your pocket, and it's going to allow that rehab money to be sitting there as a safety net unless you need it. And you'll also be a bit more liquid in the event another deal pops up when you're not exited the first one, allowing you to do more than one deal at a time.
That's a very, very good point. It's one, the cost of opportunity, missing an opportunity, having that money, your own money on the sidelines. But I've seen people get hurt because they've run out of project money, right? So just planning this ahead, even knowing that you have money to complete the project, just having that availability in case you open up the wall. You said earlier, you open up the wall and there's we didn't see this coming. And now you may not have had enough money to complete the project as you thought you were going to come in with. And now you're trying to raise money, you're trying to borrow money, you're trying to get it to the closing table any which way you can. And it's happened to me personally, right? Like early on in my career, I was trying to rehab properties, and I'd be maxing out my credit cards just trying to get through, the last faucet, So
it's the number one reason for default.
Yeah.
It's not understanding the rehab process. And there really isn't, you can go to your local RIAs, your real estate investor associations, and they do like rehab ready. Like for instance, North Carolina RIA does it, where they take you out to the project, walk you around, show you how to rehab. But understanding the construction side of the business is something that just takes a long time. It takes practice. It takes opportunities, understanding things that most people don't know if you don't have a trades background. No. And that is certainly the number one reason people default on hard money loans. And we've had clients come back saying, hey, we need more money. And well, the lender can't give you more money after the loan is closed. You
Right.
have to go seek private money, or to your point, other trade lines like credit cards you have. But at the end of the day, a good lender is going to do a feasibility study on your rehab to make sure you have the money that's properly allocated. And one thing I do see is most people will say, hey, I need $1,000 to paint this house. Well, I understand that you might be painting it, but
1980.
yeah. But in all reality, the lender's going to want the money there in the event you default. What is it going to cost them? They're not going to
Right.
come in there and paint it themselves for $1,000. And in all honesty, you should want more money there. What happens to you if you can't paint it? You're going to want more access. We
Right.
build in contingencies into our budgets of either 5 or 10% just to give you a buffer. And we can also pull money from other line items or do change orders if something arose that was unexpected. But ultimately, at the end of the day, do your own due diligence, because the lender's inspection, if they do one, is a paperweight for the file. It might be a virtual inspection at best, and
Right.
it's not going to reveal. Hey, I give you a perfect example. In Indiana, a gentleman bought a hoarder house, got in there, realized there was 10 dead raccoons in the attic, and it was just an entire mess and needed another $20,000. So it does put you in a really drastic situation. Unless you can go raise that capital, you're potentially facing default.
You don't know how hard it is to raise $20,000 until you have to
Have to
raise
raise, yeah,
$20,000.
yeah,
You know, so you're like, oh, I got friends. You got nobody. When you
yeah.
really need them, you don't got nobody. So it's better to plan ahead so you don't have to go through that stress. Now, with that being said, all the stress and everything, and people are looking at me like, look, you're not buying anything because nobody's buying anything. How are you seeing the market right now? The whole, what's working for people? Are people rehabbing properties? Are they just, what are you seeing out there in the trenches as the lender?
Yeah, so we are in the unique position of having extreme market intel on the hard money, private money side, because not only are we lenders, but we're brokers. So I know what every bank's doing. I have every bank calling me for certain types of loans. I know what their volume looks like. I know how it's split, whether it's fix and flip or long-term financing. Just today, Bigger Pockets, which were a part of that community, a featured lender in Bigger Pockets, sent out an article about mortgage requests, and they're at the lowest request rate, if you will, since 1995. So we are absolutely seeing, and you're seeing it more on the traditional home buyer side,
Yep.
rates at 8% for primary mortgages. There's no up movers, people wanting to get rid of their 2-3% that they got during COVID because they can't get that again. And accessing that equity doesn't help them achieve moving into a bigger property if their new interest rate 7-8%. So
Right.
there is definitely a cool off on the market. One of the larger lenders in our space just told me yesterday they're down 15%. We actually had our highest month of the year. So and again, we're not the largest, but we're not the
Right.
smallest. So I'm seeing still more deals. People are just offering less, and the sellers have to understand that. Um, we work a lot with off-market wholesale properties, so wholesalers aren't stopping negotiating and getting deals. Yes, they're getting less deals. They're not selling as many to hedge funds and everybody else. But I would absolutely say the market has cooled off some. And again, we are also 6 million homes short in this country. So the scarcity problem still drives the market and is sort of propping the market up despite inflation and everything else. As far as interest rates, the next Fed meeting's in 41, 42 days. It's anticipated there'll be no rate increase. We're just going to stay at that high rate. Nobody has a crystal ball, but my outlook, at least for the future, is you're going to want to buy and hold as many single family assets that are around your median home price as possible, because when rates do drop in year 25 or 26 or whatever that is, it's going to balloon the market again, because you're going to have a mass amount of qualified buyers in that space again, which is going to drive your prices up. So
Right.
you should have an idea of, I'm dating the rate right now, but I'm marrying the property.
Right.
Yes, I'll have a high interest rate. Yes, I'll have less cash flow. But this is a play of, hey, can I hold it for 2-3 years, get a little bit of cash flow, have that renter pay down my principal, use a 1031 exchange to avoid capital gains costs, and liquidate at a time when the market's at its peak for sellers again. which is
Right.
going to happen because, again, we are 6 million homes short. We're not going to achieve that in a 3-year period of just building as much as we need. So acquire as much as possible. Just know that, yes, it's a bit more difficult, and you may have to extend your market outside of Orlando or Tampa if that's where you're targeting, or Charlotte or Raleigh, and go to the secondary and tertiary markets where maybe there's more deals to be had.
Yeah. Yeah. I mean, me myself, I've expanded my team to service more markets as well. So just because, there's only a finite amount of transactions happening in my current market. So, very good. As far as the shortage is concerned, are you seeing any, small, uh, rehabbers or fix and flippers, right, going into new construction builds, picking up scatter lots more. I had a mastermind meeting with a partner of mine, and we're actually interested in exploring that option. Do you think maybe that way would be better for some people to explore more?
Yeah, I think the build to rent model is extremely popular. It's what Wall Street's interested in, and we get more requests for it. The difficulty with it is on the hard money ground up construction side, one of the underwriting guidelines that is fairly industry standard across most banks is you have to have new build experience within the last 3 years. And most people don't, and understandably so. So if somebody can go into a local bank, credit union, or even your larger bank and get a construction loan that way, and maybe refinance out into a DSCR loan or bank statement loan, more investment long-term financing, they should start with that path, because most ground up construction hard money lenders are going to say, hey, how many new builds do you have? And if you have zero, you're going to have to get somebody on the entity that does, so you can use their experience. And they don't have to own a certain percentage necessarily, even if it's 1% of the entity. And we'll at least have somebody that's tied to that loan that does have that new build experience. Now, if you have extensive rehab or moderate to extensive rehab experience, sometimes that can, supplement the lack of new build experience to get qualified. But yes, that is a good model. It's just a matter of most people don't qualify right now. One interesting thing we're seeing that's a newer product, or somewhat newer, but newer, that it's being rolled out by a number of banks right now, and you'll probably see more do it, is on the debt service coverage ratio loans. And anybody that doesn't know what that is, it's a measure of your principal, interest, taxes, and insurance and association dues versus what your mortgage payment would be. And for us, as long as, let's say, your PITIA, your total monthly payment's $1,000, as long as we can determine your rental income would be $1,000 on the property, it's qualifying. That's a debt service coverage ratio. That's how we underwrite it and mitigate the risk without looking at your pay stubs, tax returns, and all of that. So what we're seeing in the market is most people aren't qualifying for a DSCR loan because, take Florida, your insurance is so high, highest in the country, astronomically high. And when you're looking at values are now higher, rates are higher, that DSCR becomes harder to qualify, thus making it harder to do things like BRRRR and pull your cash out.
Right.
So what banks are rolling out are no DSCR loans. So they're essentially DSCR loans that are saying, we'll go below 1. You could be at negatively cash flowing, essentially. We'll still do your loan. We just want to see maybe X, Y, and Z other things. Like maybe you have more capital and you're well capitalized, or your score is above a 720. So that's an interesting product that not only has been rolled out by 2 major banks, one we're offering ourselves now. And I think you're going to see a lot more people, because unfortunately, everybody that got into a property, into a bridge loan and did some fixing up to rent it is now stuck either trying to sell it and they can't get the number they want, or they can't refinance to get their cash out and they don't have the capital to bring to closing. So they're being forced to do these no DSCR loans. The only concern is you're negatively cash flowing.
See,
So
I have a problem with that, right? I came from an environment of 2005, 6, 7, where we were purchasing properties basically on speculation. Right now, I know because I'm looking 20 years in my rearview mirror. But we're purchasing properties on speculation, not fundamentals. We're looking at properties and saying, "Hey, we can buy them right now and we'll hold on to them even if we're coming out of pocket a couple $100. Just like in this example, I can hold on to it, and I'll flip it around on, in the next couple of years, and that $100 or $200 that I was putting in will be insubstantial, right? However, what happened is that I picked up a bunch of properties in the 2005, 6, 7 range, and then the bottom falls out, right? If this was a very unique market, so this may not happen again. But when an economy shifts, and all economies shift, right? There's more unemployment, and then there's more people that can't pay their mortgage or can't pay the rent. The reason that we didn't have this during the 2020s is because everybody went on an immediate stay, right? You couldn't evict anybody, so it was a little different. But man, there was people that were struggling, landlords that were struggling at that time because they couldn't make their mortgage payments. And all it takes is one little, instability in the marketplace to throw you off, and now you're not down $100 or $200. You already were down $100 or $200. Now you're down $300 or $400, and now that starts to hurt and dwindle. And then how do you get rid of the property? Right. So I think the DSCR loan works so well because if the numbers don't work, then you ask the customer to come in with more down payment, and then you make the deal work. Worst case scenario, you have a little bit of loss in rent or something, taxes go up or something like that. It's not that bad, right? I don't know. I think it's a recipe for people getting hurt.
I completely agree with you. And back in 2010, I worked for one of the fastest growing law firms in Florida, and we had there was 480,000 foreclosures in 2010 in Florida. We saw more than anywhere else in the country. So I saw like what was happening in the bloodbath of subprime lending. All we've done is rebranded that as non-QM, non-qualified mortgage. And I don't think people understand the macro of this business is all of these loans, no matter who the bank is, get sold to Wall Street. They get packaged together, securitized, and sold as a bond that backs your teachers union and your firefighters and everybody else. So when that real estate market crashes, as much as everybody was screaming, let's not bail out Wall Street, if you don't bail out Wall Street in the real estate mortgage-backed security industry, it's going to have a domino effect on everybody's pensions.
Right.
So to your point of doing these loans, we're in the same space as we were before to a degree, and I'm sure there's people that argue with that. But I also agree with you is the no DSCR product needs to be a last resort. It is not the first resort. It is not, maybe you need to change your exit strategy of how you're renting it. Maybe go midterm rental, short-term rental, pad split, something to get a premium above your rent to make that number work. Because if you're negatively cash flowing and there's not some other long-term play of it's double lotted or I'm using it for tax depreciation or something else that makes sense in your business model, man, to your point, if you kept doing that, you could be underwater if that market shifts even worse, and you're going to lose far more than you were just by taking a loss on that deal by liquidating it at a cheaper price that you really wanted to. Sometimes in this business, singles are better than home runs, and even striking out is better than being ejected, if you will.
It's true. It's very true. Yeah, Mark. I mean, I love sharing, the market, back and forth, seeing what you're seeing out there. And so what are you seeing that's working the best for people right now, investors and home buyers, really?
Yeah, I think having really clarity on what you're buying and just being aggressive with your numbers, letting the deal come to you and deciding what the best exit strategy on the deal is. As much as this doesn't help me, your best is creative financing at this time. Can you take over 2-3% mortgages through sub 2? That's a tool you need to be able to have. Do you understand how to do, silent seconds and carrybacks to make deals work and keep more money in your pocket? Listen, deals are still working. It's maybe you need to change your market, and it's just, hey, for the time being, I, can't be in Miami. I have to look at Alabama or somewhere else that's going to be better cash flowing. We're all dealing with the same market conditions. It's just how do you adjust your business, your numbers to make it all work? And are you, again, working with somebody that can help you do that? So we're seeing a number of things still working. Pad split is a growing model for people. Banks are still trying to figure out how to get on board with that stuff. But at the end of the day, you have to understand all the tools in your tool belt, let the deal come to you, and then pull out the appropriate tool for that deal and always have a plan B. If you're going to go midterm rental or pad split or short-term rental, understanding, hey, if I can't do this as a short-term rental or this shifts, can I stick a long-term tenant in there? And will it still cash flow for me? So again, we're all facing the same winds of the economy. Just set your sail appropriately.
Yeah, you're the second person to come on the show and tell everybody that, in essence, the deeper your toolbox, the more money you're going to be able to make, because you're going to have more options, right? I can wholesale this, I could burr this, I can fix and flip this, or I can do a creative financing strategy, and I'm going to make this work. So that's an awesome note to end on right there, Mark. I appreciate you coming on and sharing some insights, and I'd love to have you back on again as a guest again, and let us know what's going on. Mark, let people know where they could find you. CapSource is an excellent resource for me. I recommend them highly. They've done great things for my buyers. So please, Mark, plug in where they can find you guys.
Yeah, they can reach us at thecapsource.com. I'm on Instagram at CapSourceCFO, my business partner at CapSource CEO, John O'Leary. And, Yubel, you're always great to work with. I refer my clients to Yubel because I do want to work with good investor-friendly agents. Reach out to me. I'm at mark@thecapsource.com. Anything we can do. If you're local to us, we're in Winter Park. If not, we're across the country, involved in a lot of RIAs. So I appreciate the opportunity. Love to be on here again, and always like talking real estate with you, Bell.
Money in 40 states. There you go. Have a good